The silver market does not move loudly. It never has. It does not announce itself with headlines, viral tweets, or breaking news alerts. When silver moves, it moves quietly beneath the surface where most eyes never look. And that is exactly why what just happened matters. Because while the world was distracted, while retail investors chased momentum, while algorithms played their daily games, someone or something began accumulating silver. Not millions, not tens of millions, hundreds of millions of dollars worth. Quietly, systematically, without fanfare. Over $650 million. No press release. No public disclosure. No obvious buyer stepping forward. Just flows. Just numbers. Just data. And in markets like silver, data never lies even when people do. To understand why this matters, you have to understand one uncomfortable truth. Silver is not priced like a normal commodity. It is not priced by supply. It is not priced by demand. And it is certainly not priced by physical reality. Silver is priced by paper. A market where promises trade more frequently than metal, where contracts outnumber ounces, where leverage hides scarcity. For decades, this system worked not because it was honest, but because it was uncontested. Because when someone commits hundreds of millions into silver quietly, they are not chasing a short-term trade. They are positioning. And positioning only happens when someone sees what others don't, or what others refuse to acknowledge. Silver today sits at the intersection of multiple pressures. Industrial demand is rising. Energy transition requires it. Electronics depend on it. Solar technology cannot function without it. Yet supply growth remains stagnant. Mines take years to develop. Ore grades are declining. Production costs are rising. This alone would be enough to tighten the market. But silver is not just an industrial metal. It is monetary. It has been money longer than almost any currency alive today. And monetary metals behave differently when trust breaks down, when confidence in systems erodes, when debt expands faster than productivity, when currencies lose purchasing power quietly, year after year. Silver doesn't react immediately. It waits and then it moves violently. Historically, silver never warns the crowd. It punishes complacency. The paper-silver market, however, tells a different story. On paper, silver is abundant, unlimited even. Contracts can be created at will, short positions rolled endlessly, delivery postponed, settlement deferred. As long as participants accept paper instead of metal, the illusion holds. But illusions require belief, and belief is fragile. That is why physical accumulation matters, because physical silver cannot be rehypothecated infinitely. It cannot be conjured with keystrokes. It cannot be settled with promises. Every physical ounce removed from circulation tightens the system, and when someone removes a lot of ounces, the system notices, even if the public does not. The question then becomes who would do this? Sovereigns, institutions, industrial users hedging future shortages, a fund positioning for systemic stress. The answer matters less than the intent, because whoever is buying is not speculating, they are preparing. Preparing for a world where paper claims are questioned, where delivery matters, where trust is not assumed, and timing matters. This accumulation did not happen at a market peak. It did not happen during euphoria. It happened during boredom, during disinterest, during neglect. That is when smart money moves. Retail investors chase confirmation. Institutions chase asymmetry, and silver today offers a symmetry few assets can match. Downside appears limited by cost of production. Upside is uncapped if confidence in paper breaks. This is not a theory. We have seen it before. Every major silver revaluation followed the same pattern. Suppression, disinterest, accumulation, shortage, then repricing. The quiet phase is always the longest, and the most important, because once the crowd notices, the opportunity is gone. The presence of a massive buyer does not guarantee immediate price movement. Markets can remain irrational longer than participants expect, but it does change the structure. It tightens supply. It increases delivery pressure. It reduces margin for error. And it exposes the fragility of a system built on leverage. When physical demand collides with paper dominance, something must give. Either prices rise, or delivery fails. There is no third option. That is why this purchase matters now. Not because silver has already moved, but because someone is positioning for when it does. And when silver moves, it never asks for permission. It moves fast. It moves violently. And it leaves disbelief behind. The question is not whether silver will matter again. The question is who will be positioned when it does. Because by the time it becomes obvious, it is already too late. Silver is traded more on screens than in vaults. The paper-silver market is many times larger than the physical market. Most silver trades never result in delivery. They end as cash settlements. This structure works only while confidence remains intact. Physical silver cannot be printed. Paper silver can be created instantly. Every new contract increases leverage. Leverage hides scarcity. Scarcity reveals itself only under stress. Industrial demand does not wait for price discovery. Factories require metal, not contracts. Solar manufacturing consumes silver permanently. Once used, that silver rarely returns to the market. Recycling cannot keep pace with new demand. Mine supply grows slowly. Permitting delays are measured in years. Capital costs are rising across the mining sector. Energy prices directly affect silver production costs. Higher costs are not reflected in current prices. This creates pressure beneath the surface. Large buyers do not chase momentum. They exploit mispricing. They enter when volatility is low. They enter when attention is elsewhere. $650 million is not retail capital. This is not emotional buying. This is allocation. Institutional buyers avoid moving markets visibly. They spread purchases across time and venues. They use intermediaries. They avoid headlines. Silence is part of the strategy. Physical accumulation tightens available float. Tight float increases delivery risk. Delivery risk exposes paper leverage. Paper leverage depends on rollover. Rollover depends on trust. Trust is the weakest variable. Silver's monetary role resurfaces during instability. It has no counterparty risk. It carries no default risk. It does not rely on central banks. Historically, silver lags gold before outperforming it. This lag creates frustration. Frustration creates neglect. Neglect creates opportunity. When silver breaks higher, liquidity disappears quickly. Bid-ask spreads widen. Availability drops. Premiums rise before spot prices do. This has happened repeatedly. It is not theoretical. Physical shortages do not announce themselves early. They appear suddenly. By the time they are reported, they are already advanced. Paper prices can stay suppressed longer than expected. They cannot stay suppressed indefinitely. Eventually, physical reality asserts itself. Large buyers position before that moment. They do not need confirmation. They only need imbalance. This accumulation suggests anticipation, not reaction. It suggests preparation for disruption. Markets reward those early to structural shifts. They punish those late to obvious ones. Silver's structure is fragile. Fragility is invisible during calm periods. It becomes obvious only during stress. This buyer appears to be positioning for stress. The identity of the buyer matters less than the behavior. The behavior points to institutional intent. Retail investors do not deploy hundreds of millions quietly. Hedge funds usually seek liquidity and speed. This accumulation shows patience. Patience is expensive capital. Sovereign entities often diversify without disclosure. They avoid market disruption. They value strategic metals. Silver fits that category. Industrial consumers hedge future supply risk. They secure metal before shortages appear. They operate off-market when possible. Commodity trading houses accumulate inventory ahead of stress. They profit from dislocations, not predictions. Large asset managers relocate during periods of neglect. They prefer asymmetric setups. Silver currently offers asymmetry. Central banks rarely hold silver directly. They influence markets indirectly. Private vault flows reveal more than official statements. Warehouse movements often precede price shifts. Delivery requests increase before volatility. Inventory drawdowns are early signals. Registered stocks are more important than total stocks. Eligible metal does not guarantee availability. Only registered metal is deliverable. Declining registered inventories increase risk. Paper shorts depend on metal staying idle. When metal moves, shorts become exposed. Exposure forces decisions. Decisions create volatility. Silver's volatility is historically extreme. Small imbalances cause large price reactions. The market is thinner than it appears. Liquidity vanishes under pressure. Price discovery becomes chaotic. Past silver rallies were disorderly. They were not gradual. They were not polite. This accumulation suggests awareness of that history. It suggests positioning before disorder. Large buyers accept opportunity cost. They wait for repricing. They do not require immediate validation. This is strategic capital, not speculative capital. Strategic capital anticipates regime change. Regime change rarely arrives with warning. It arrives with stress. Silver performs during stress, not stability. This buyer appears to be aligned with that reality. Delivery is the weak point of the silver market. Most contracts are never meant to settle in metal. They are designed to roll forward. This reduces visible stress. It does not remove risk. When delivery requests increase, pressure concentrates. Warehouses must source real metal. Sourcing becomes difficult during tight supply. Delays expose imbalance. Cash settlement becomes the fallback. Cash settlement signals strain. Physical buyers reject cash during shortages. They require metal. Registered inventory represents deliverable supply. Eligible inventory represents potential supply. Eligible metal can disappear overnight. Owners can withdraw it at any time. Only registered metal is committed. Declining registered stocks increase failure risk. Failure does not require zero inventory. It requires insufficient inventory. Silver inventories are thin relative to paper claims. This ratio is historically stretched. High leverage magnifies small shortages. Small shortages trigger large reactions. This is structural, not emotional. Delivery stress forces shorts to respond. Response options are limited. Covering raises prices. Delaying damages confidence. Confidence loss accelerates demand for delivery. This feedback loop is dangerous. Past commodity crises followed similar paths. They began quietly. They escalated rapidly. Silver's market size amplifies volatility. It is smaller than gold. It is more reactive. Price moves can be violent. Spreads widen quickly. Liquidity evaporates. Physical premiums decouple from spot prices. This decoupling is an early warning. It indicates real-world scarcity. Paper prices lag physical reality. Eventually, convergence occurs. Convergence is rarely smooth. This accumulation suggests anticipation of that moment. It suggests preparation for delivery pressure. The market has not priced this risk. Silver shortages do not begin at mines. They begin at refineries. Refining capacity is a bottleneck. Bottlenecks delay delivery. Delays expose fragility. Most silver is produced as a byproduct. Primary silver mines are rare. Supply cannot respond quickly to price. Higher prices do not instantly create more silver. Industrial demand ignores price signals. Production schedules are fixed. Manufacturers secure inputs regardless of volatility. Silver demand is inelastic during shortages. Investment demand is optional. Industrial demand is mandatory. This difference matters under stress. Above ground silver stocks are finite. Much of it is already committed. Much of it is not for sale. Visible inventories mislead observers. Ownership matters more than volume. Metal held for strategic reasons does not return to market. Long-term holders ignore short-term price swings. They care about availability. They care about continuity. Silver inventories have been declining in real terms. Reported numbers lag reality. Data revisions occur after stress events. Transparency decreases during volatility. Market participants discover shortages late. Late discovery causes panic. Panic accelerates demand. Accelerated demand overwhelms supply. This sequence repeats across commodity history. Silver is no exception. Paper markets delay price discovery. They do not eliminate it. Suppression compresses volatility. Compressed volatility eventually expands. Expansion is sudden. Expansion is violent. Silver has a history of extreme percentage moves. These moves are not forecasted accurately. They occur outside expectations. Risk models underestimate silver volatility. Underestimation increases exposure. Exposure magnifies losses. Losses force liquidation. Liquidation feeds momentum. Momentum feeds repricing. Repricing breaks old assumptions. Assumptions fail quickly during stress. Trust erodes faster than liquidity. Once trust breaks, paper claims lose priority. Physical possession gains value. Settlement preferences shift. Cash becomes secondary. Metal becomes primary. This inversion shocks participants. Markets are not designed for this shift. Rules adapt slowly. Stress adapts quickly. Silver's dual role complicates resolution. It is both commodity and money. Commodity shortages create economic friction. Monetary demand amplifies that friction. Amplification accelerates repricing. Authorities prefer stability. Stability conflicts with reality. Intervention can delay outcomes. It cannot erase them. Delays increase magnitude. Magnitude increases systemic risk. Systemic risk changes behavior. Behavior changes demand patterns. Demand patterns reshape markets. Silver responds faster than policy. Policy responds slower than markets. This gap creates opportunity. It also creates danger. Large buyers understand timing asymmetry. They move before narratives shift. Narratives follow price, not lead it. Media reacts after volatility. By then, accumulation is complete. Late entrants face scarcity. Scarcity increases cost. Cost changes psychology. Psychology drives momentum. Momentum ignores fundamentals initially. Fundamentals assert themselves eventually. Silver fundamentals are supply constrained. Demand trajectories are upward. This imbalance persists regardless of sentiment. Sentiment cycles obscure structure. Structure dictates outcomes. Outcomes surprise participants repeatedly. History documents these surprises. They are rarely learned from. Each cycle feels unprecedented. Each cycle follows familiar mechanics. Leverage builds quietly. Stress exposes leverage suddenly. Resolution is chaotic. Order is restored at new price levels. These levels reflect reality. Reality cannot be negotiated indefinitely. Silver's market is too small to absorb shocks smoothly. Small inflows create outsized effects. Large inflows destabilize equilibrium. $650 million is significant. It represents intent. Intent precedes action. Action precedes repricing. This accumulation signals foresight. Foresight is rare. It is usually dismissed early. Dismissal creates opportunity. Opportunity exists only briefly. Once obvious, it disappears. Silver's quiet phase does not last forever. It ends abruptly. When it ends, participation changes, volatility becomes dominant, narratives reverse. Skepticism turns into urgency. Urgency turns into scarcity. Scarcity turns into repricing. Repricing resets the market. The reset is not gentle. It favors preparation over reaction. This buyer appears prepared. Historical silver breakdowns. Paper failure mechanics. Volatility explosions. Post-repricing behavior. Silver market stress rarely starts with price. It starts with availability. Availability disappears quietly. Dealers adjust premiums before headlines appear. Premiums reflect reality faster than spot prices. Spot prices reflect paper consensus. Consensus lags physical truth. This lag creates distortion. Distortion attracts informed capital. Informed capital moves early. Early movement looks insignificant at first. Significance appears only in hindsight. Silver vault withdrawals are not random. They follow demand signals. Demand signals rise before fear. Fear follows shortages. Shortages follow accumulation. Accumulation leaves footprints. Footprints appear in inventory reports. Most observers ignore these reports. They are not designed for headlines. They are designed for operators. Operators watch flows, not opinions. Flows reveal intent. Intent reveals positioning. Positioning precedes repricing. Silver's price history is misleading. It understates volatility risk. It understates upside velocity. It overstates market depth. Depth vanishes during stress. Market makers withdraw first. Liquidity providers protect capital. They widen spreads. They reduce size. They step back. This accelerates instability. Instability increases margin requirements. Higher margins force liquidation. Liquidation distorts price signals. Distorted prices trigger algorithmic responses. Algorithms amplify moves. Amplification overwhelms fundamentals temporarily. Temporary chaos produces permanent consequences. Contracts fail under extreme stress. Rules change during emergencies. Emergency rules favor system stability. They do not favor fairness. Physical holders are insulated. Paper holders are exposed. This asymmetry defines silver crisis. It has repeated multiple times. Each time, disbelief dominates early stages. Disbelief delays response. Delayed response increases damage. Silver does not collapse slowly. It reprices abruptly. Repricing shocks balance sheets. Shocks force reassessment. Reassessment shifts capital. Capital rotation follows crisis. Silver attracts attention late. Late attention drives extremes. Extremes end cycles. Cycles reset narratives. Narratives rewrite history. History becomes simplified. Complexity is forgotten. Lessons are ignored. The next cycle begins quietly. This cycle shows familiar signs: rising industrial dependency, constrained mine supply, elevated leverage, compressed volatility, institutional accumulation, public disinterest. These conditions rarely coexist by chance. They indicate structural imbalance. Structural imbalance resolves only one way: through price. Price adjusts to availability. Availability adjusts to ownership. Ownership is changing. Metal is moving into strong hands. Strong hands do not sell into noise. They sell into euphoria. Euphoria does not exist yet. That is the point. Silver is still dismissed. Dismissal creates inefficiency. Inefficiency attracts capital. Capital reduces float. Reduced float increases sensitivity. Sensitivity increases volatility. Volatility reveals truth. Truth forces repricing. Repricing changes incentives. Changed incentives reshape supply chains. Supply chains react slowly. Markets react instantly. This mismatch creates opportunity. It also creates instability. Stability is an illusion during transitions. Transitions favor preparation. Preparation is invisible. Reaction is visible. Visibility comes too late. Silver's market does not forgive delays. It penalizes hesitation. It rewards foresight. Foresight is uncomfortable. It requires acting without validation. This buyer acted without validation. That is the signal, not the price, not the headlines, the behavior. Behavior reveals expectation. Expectation reveals risk assessment. Risk assessment suggests disruption. Disruption does not require prediction. It requires imbalance. Imbalance already exists. The market has not acknowledged it. Acknowledgement comes later, usually violently. The silver market has always revealed its truth late, never early. By the time prices react, the underlying shift has already happened. What changes first is not valuation, but behavior. Inventory begins to move differently. Delivery preferences change. Contracts that were once rolled without question suddenly face resistance. This is how stress enters a system built on assumption rather than availability. For years, the paper-silver market has functioned because most participants never intended to touch metal. The system relied on trust that delivery could happen if required, trust that inventories were sufficient, trust that paper and physical were interchangeable. That trust reduced urgency. It allowed leverage to expand quietly. It allowed claims to multiply far beyond the metal that supported them. But leverage only works in calm conditions. It becomes fragile when even a small portion of participants demand certainty instead of convenience. Physical silver introduces that demand. It removes flexibility. It forces accountability. Every ounce that leaves a warehouse reduces optionality for the system as a whole. What makes the recent accumulation notable is not just its size, but its timing. This buying did not occur during panic or headlines. It occurred during indifference. Volume was muted. Volatility was compressed. Sentiment was flat. These are not the conditions under which emotional capital enters markets. They are the conditions preferred by strategic capital. Strategic buyers understand that markets do not reprice when stories are convincing. They reprice when structures break. In silver, the structure is thin. The market is small relative to global capital. It does not require widespread participation to destabilize it. It requires only persistent removal of available supply. As physical silver is accumulated, the burden shifts to remaining inventory. Each additional delivery request concentrates risk. At first, this pressure is absorbed quietly. Then premiums begin to rise, not in futures prices, but in real transactions. Dealers adjust terms. Availability narrows. Choice disappears before price does. This divergence between paper price and physical reality is not an anomaly. It is a warning. It signals that the market's reference point is becoming unreliable. When that happens, confidence erodes unevenly. Some participants adapt early. Others assume normality will return. Historically, silver does not resolve these tensions gradually. It waits, it compresses, then it moves decisively. Liquidity vanishes at the moment it is needed most. Price discovery becomes chaotic. Participants accustomed to orderly markets are forced to react under pressure. The presence of a large, disciplined buyer suggests anticipation of this phase. It suggests recognition that silver's current price does not reflect its structural constraints. It suggests preparation for a moment when delivery matters more than settlement and possession matters more than price. This is not a prediction of timing. Markets rarely reward precise forecasts. It is an observation of imbalance. And imbalances, once established, do not resolve themselves quietly. Silver's role as both an industrial input and a monetary asset magnifies this dynamic. Industrial demand is indifferent to narratives. It is governed by necessity. Monetary demand responds to trust. When trust weakens, silver absorbs that uncertainty. At some point, the system is forced to reconcile paper abundance with physical limitation. That reconciliation is never smooth. It redefines value abruptly. Those positioned early are rarely visible. Those reacting late are highly visible. By the time silver's importance becomes obvious, the conditions that created the opportunity no longer exist. The quiet phase ends. The market changes character. And what once seemed irrelevant becomes unavoidable. The system begins to fracture in subtle ways. Paper positions become vulnerable long before prices spike. Short positions accumulate quietly, and the leverage that seemed safe suddenly magnifies exposure. Each contract depends on counterparty confidence. Each ounce of physical metal outside the system reduces flexibility. The market is not just under pressure, it is constraining itself. Warehouse inventories are the first signal. Registered stocks shrink. Eligible metal may exist, but it is not committed. Brokers manage risk, and they begin rationing access. Delivery requests increase, but not all can be fulfilled. Premiums widen, sometimes unnoticed in futures markets. The divergence between paper and physical is no longer theoretical, it becomes observable. Early participants see it. The broader market still believes in paper liquidity. During this stage, volatility is deceptive. Futures prices may drift within narrow ranges. The narrative remains that nothing unusual is happening. Most retail investors are distracted, focusing on daily headlines or minor fluctuations. Meanwhile, informed capital quietly reduces risk, secures metal, and positions for the inevitable repricing. When the tipping point arrives, the system reacts violently. Orders cannot be filled at anticipated prices. Spreads widen exponentially. Algorithms designed to manage risk exacerbate the move, selling into weakness and buying into panic. The paper market struggles to reconcile claims with reality. Participants discover that liquidity is not infinite. Physical scarcity dominates sentiment. Historical examples illustrate the same pattern. In past silver squeezes, the initial phase was almost invisible. Exchanges and warehouses quietly registered withdrawals. Shorts were not immediately aware of the scale. Prices moved slowly at first, lulling participants into complacency. Then, as supply tightened further, the market accelerated abruptly. Panic replaced disbelief. Liquidity evaporated. Spot prices surged. Paper settlements lagged reality. Those unprepared were forced to liquidate under extreme conditions. Silver does not wait for narratives or media coverage. It does not respond to consensus forecasts. It responds to the fundamentals of supply, demand, and possession. Once physical pressure exceeds paper elasticity, the market corrects itself with sharp, unforgiving efficiency. Strategic buyers, having positioned early, experience this repricing advantage first. Those relying on delayed data or sentiment indicators face the consequences. The dual nature of silver, both industrial commodity and monetary asset, amplifies the effect. Industrial users continue consuming metal regardless of price, creating constant demand. Monetary demand emerges as trust in paper claims falters, drawing capital into tangible silver. The convergence of these pressures accelerates repricing. The initial quiet accumulation transforms into a rapid, systemic shift, leaving unprepared participants exposed and forcing a recalibration of risk. During this transition, traditional assumptions about market behavior fail. Historical patterns based on paper trading or short-term sentiment no longer apply. Every delivery, every vault withdrawal, every concentrated purchase becomes meaningful. Markets that once seemed liquid are suddenly constrained. Contracts and promises take a backseat to actual ounces. Reality enforces its own timeline. Observers who rely on conventional data miss early signals. Registered inventories decline steadily, but total stocks appear stable. Eligible metal gives a false sense of security. Only physical possession confirms availability. The market becomes bifurcated. Those with physical metal hold power, those with paper are exposed. This asymmetry drives volatility and uncertainty, accelerating the next phase of repricing. By the time public awareness catches up, the quiet phase is over. Volatility spikes, premiums widen, market depth contracts, price movement accelerates. The correction is not proportional, it is exponential. Those positioned early benefit, those late face losses or forced liquidation. The market demonstrates the fragile balance between leverage, trust, and physical reality, exposing structural vulnerabilities that are invisible under calm conditions. Silver's history proves that cycles of accumulation, compression, and sudden repricing repeat. Each cycle has a unique trigger, but the mechanics remain consistent. Accumulation creates scarcity, scarcity pressures delivery, delivery stress exposes leverage, and leverage magnifies repricing. Strategic participants exploit this cycle. Unprepared participants react to it. Understanding this sequence is essential for anticipating potential shifts in value. As pressure builds, the distinction between paper and physical silver becomes impossible to ignore. Contracts that once settled with ease face delays. Dealers are forced to source metal that has already been allocated. The system strains under obligations it cannot meet immediately. Prices begin to reflect scarcity rather than speculation. Spreads widen, volumes shift, liquidity thins. During peak accumulation, early buyers hold leverage over the market. They can choose to delay release or concentrate supply. Their actions define the timing and severity of the next move. Observers outside this circle see only price shifts and hear speculation. They do not see the structure bending under invisible weight. Historical silver disruptions follow a predictable arc. Initial accumulation is subtle. Market participants assume stability. Short positions build. Retail participants remain distracted. Then scarcity emerges quietly. Deliveries fail or are delayed. Premiums rise. Prices accelerate. Panic replaces disbelief. Margin calls trigger liquidation. Algorithms amplify movements. Market chaos ensues before reality stabilizes. The dual role of silver exacerbates these effects. Industrial demand continues relentlessly. Monetary demand reacts to shifts in trust. Supply cannot increase instantly. Metal is finite. Paper promises are plentiful. The collision of demand and constrained supply drives repricing. The more leverage in the system, the greater the acceleration once scarcity is acknowledged. By the time news outlets report anomalies, the market has already adjusted. Early participants capitalize, late participants are forced to react. Repricing is rarely linear. It is violent, sharp, and often concentrated over short periods. Historical data shows that during these periods, the gap between paper price and actual physical cost can widen dramatically. This pattern repeats across decades. Every major silver surge involved quiet accumulation, constrained supply, and sudden repricing. The triggers vary, but the mechanics are consistent. Those who understand the cycle prepare. Those who dismiss signals are surprised. Each cycle reinforces the same lesson: physical scarcity drives outcomes more than paper speculation. Delivery failures are the most telling indicator. They confirm that available metal is insufficient to meet obligations. Registered inventories decline faster than reported totals. Eligible stocks give the illusion of sufficiency, but true availability is limited. This gap is what magnifies volatility during stress. The moment delivery becomes uncertain, the market enters a new phase where control shifts from paper holders to physical owners. Volatility, in turn, reshapes participant behavior. Those with short positions are forced to cover. Those with liquid capital seek to secure metal. Algorithms react, often exaggerating human responses. Price discovery accelerates. Liquidity disappears precisely when it is needed most. Physical scarcity dominates market psychology, replacing sentiment with necessity. This stage defines silver's unique dynamics. Unlike other commodities, its dual industrial and monetary nature ensures that stress is not isolated. Industrial usage continues. Investment demand reacts to perceived scarcity. Market participants discover that leverage, trust, and paper claims have limits. Repricing is swift. Market assumptions are reset. The lessons of quiet accumulation are revealed in a sudden, indisputable manner. Those positioned early experience this as opportunity. They hold tangible assets in a system constrained by scarcity. Those unprepared encounter exposure amplified by leverage and delayed realization. Markets that seemed orderly collapse under the weight of structural imbalance. Scarcity drives price, and price drives behavior. By observing these patterns, it becomes clear that accumulation during periods of indifference is strategic, not speculative. The market does not move randomly. It moves in response to structural pressures. Those who understand this sequence recognize that the quiet accumulation of silver is a prelude, not an anomaly. It signals a system approaching stress, where the convergence of industrial, monetary, and leveraged forces will ultimately define the next repricing event. The market reaches a critical point when delivery stress becomes visible. Contracts once assumed to be trivial now demand actual metal. Warehouse inventories shrink rapidly. Registered stocks are consumed faster than replenishment occurs. Eligible stocks exist on paper but are inaccessible in practice. The distinction between promise and possession becomes stark. Every transaction carries weight. Every withdrawal signals imbalance. At this stage, the market enters a self-reinforcing cycle. Rising premiums signal scarcity. Higher premiums force re-evaluation of positions. Participants with short exposure cover aggressively. Liquid capital chases physical metal. Each movement amplifies scarcity. Each amplification feeds volatility. Price begins to reflect reality rather than speculation. Historical patterns repeat. In the 1970s, silver experienced similar dynamics. Accumulation occurred quietly. Delivery pressure emerged unexpectedly. Paper markets failed to reconcile with physical demand. Prices accelerated violently, often in a matter of weeks. Short positions were forced to cover, intensifying the move. Liquidity evaporated precisely when it was most needed. Market participants were caught off guard, unprepared for the speed of repricing. The dual nature of silver exacerbates outcomes. Industrial demand remains constant. Production schedules cannot adapt instantly. Monetary demand reacts to uncertainty, trust, and perceived scarcity. The system is compressed between these forces. Leverage magnifies reactions. Paper contracts cannot substitute for metal. Short-term liquidity becomes irrelevant. Physical possession dictates market control. Strategic participants recognize this environment. They maintain patience. They accumulate without triggering notice. Their actions go unseen by the public, but profoundly affect market structure. By controlling available supply, they shape the timing, pace, and intensity of repricing. Early foresight transforms into advantage when scarcity manifests. The broader market, relying on delayed signals, reacts rather than leads. Volatility spikes during this phase. Algorithms designed to stabilize markets often amplify stress. Orders cascade, spreads widen sharply. Price discovery accelerates. Paper claims are tested against physical reality. The system, built on assumptions, confronts the limits of its design. Those unprepared face forced liquidation or missed opportunity. Those prepared hold leverage through possession rather than position. The climax of this phase is sudden. Markets that seemed orderly become disorderly. Premiums diverge sharply from spot prices. Paper markets struggle to reconcile obligations. Delivery failures confirm systemic imbalance. Historical parallels underscore this dynamic. Prior silver crises followed the same sequence: quiet accumulation, invisible structural stress, sudden visibility of scarcity, and rapid repricing. The mechanics are predictable even if timing is not. During the peak, every ounce matters. Each vault withdrawal carries outsized influence. Small orders generate significant market signals. The velocity of transactions increases dramatically. Participants shift from analysis to action. The market's character changes from calm observation to reactive urgency. The fragile equilibrium collapses under compounded pressures. At this point, the market demonstrates a simple truth: scarcity dominates over speculation. Paper promises lose significance. Physical possession dictates outcomes. Early positioning ensures control. Late positioning exposes vulnerability. This pattern repeats across silver history. Accumulation precedes stress. Stress triggers repricing. Repricing resets market structure and participant assumptions. Once the repricing is underway, the market does not slow for sentiment. It moves based on structural forces. Industrial consumption continues regardless of price. Monetary accumulation accelerates uncertainty. Leverage amplifies volatility. The interplay of these forces determines the speed and magnitude of correction. Observers realized that the quiet accumulation of strategic participants was not coincidental. It was deliberate, informed, and preparatory. By the end of this phase, lessons are clear. Market mechanics override narratives. Structural imbalances, once invisible, dominate outcomes. Scarcity defines price. Paper fails to substitute for possession. The system's weaknesses, exposed through stress, cannot be ignored. Those who understood the early signs hold advantage. Those who relied on delayed data experience exposure. Silver has completed a cycle, confirming historical patterns while creating new conditions for future cycles. After the peak of repricing, the market enters a phase of recalibration. Volatility begins to stabilize, but underlying structural tensions remain. Prices have shifted to reflect physical scarcity. Short-term speculation recedes. The focus moves from reaction to assessment. Participants analyze positions, inventory, and leverage. The system evaluates what survived and what failed. Physical possession now dictates confidence. Those who secured metal early maintain control. Institutions with foresight hold leverage beyond simple capital allocation. Late entrants adjust strategy, often by chasing scarcity, which further amplifies premiums. The disparity between paper claims and actual availability remains pronounced. Markets that appear deep are revealed to be thin. Liquidity is measured by possession, not by nominal contracts. During recalibration, industrial demand continues. Factories operate according to schedules set months or years prior. Industrial consumption acts as a persistent baseline. Monetary demand becomes selective, based on trust and perceived scarcity. This dual pressure reinforces price levels while testing the resilience of paper markets. Market psychology shifts from disbelief to cautious acceptance. Sentiment follows reality rather than shaping it. Exchanges adjust to new conditions. Margin requirements rise. Spreads widen. Settlement processes are stressed. Some contracts are extended. Some fail. The system prioritizes stability over completeness. Regulatory interventions may temporarily slow repricing, but they cannot eliminate structural constraints. The fundamental scarcity of metal remains unaltered. Reality asserts itself through possession and delivery. Medium-term corrections occur as participants adapt. Volatility decreases incrementally. Premiums stabilize but remain above prior norms. Short-term speculators exit positions. Strategic holders consolidate. Warehouse inventories are recalibrated. The balance of supply and demand realigns, but structural sensitivity remains elevated. The market is more fragile, not less. Future shocks will have amplified effects. Historical parallels demonstrate the pattern. Past silver cycles follow similar trajectories: quiet accumulation, structural stress, sudden repricing, peak volatility, followed by measured recalibration. Each cycle leaves markets more aware of scarcity and leverage dynamics. Lessons accumulate for strategic participants, reinforcing the advantage of early positioning. Late entrants recognize the consequences of delayed action, often incurring elevated costs or forced liquidation. During this post-repricing phase, the market exhibits asymmetry. Early strategic buyers wield influence. Late reactive participants hold limited options. Liquidity is concentrated. Spreads reflect both scarcity and urgency. Price formation is now dictated by fundamentals more than speculation. Physical possession dominates perception. Paper claims are secondary. The recalibrated market signals opportunity for those who can interpret structural data. Inventory flows, delivery patterns, and warehouse dynamics are more important than sentiment indicators. Market mechanics dictate behavior. Patterns established during accumulation and peak repricing repeat subtly. Awareness of these patterns allows participants to position advantageously for future cycles. Timing remains critical. Preparation, rather than prediction, ensures advantage. Even as volatility recedes, underlying fragility remains. Leverage is still present. Paper claims still exceed physical reality. Industrial demand continues. Monetary accumulation persists. Structural sensitivity is heightened. Markets have shifted to a new baseline. Participants must operate with awareness of limits, constraints, and the dual nature of silver as both commodity and monetary asset. By observing post-repricing dynamics, it becomes evident that silver cycles are predictable in structure but not in timing. Early accumulation, quiet structural stress, sudden repricing, and subsequent recalibration form the consistent pattern. Strategic positioning in advance of this cycle determines outcomes. Those who follow structural signals rather than narratives maintain advantage. The lessons of scarcity, leverage, and possession are reinforced. Markets, while calm, retain vulnerability. Looking beyond immediate recalibration, long-term structural positioning becomes decisive. Markets are rarely random over extended periods. Patterns, once established, reassert themselves. Participants who understand structural imbalances recognize that cycles of accumulation, stress, repricing, and recalibration repeat. The market's behavior is governed more by possession and scarcity than by short-term sentiment or headlines. Strategic accumulation during periods of indifference offers lasting advantage. Metal held quietly during calm conditions preserves leverage when the system strains. Physical possession ensures control over outcomes that paper contracts cannot replicate. Timing remains critical. Early preparation outperforms reaction. Historical cycles confirm this principle repeatedly. Future cycles will emerge from the same dynamics: limited supply growth, consistent industrial demand, leverage in paper markets, and accumulation by informed participants. These forces do not require extraordinary events to interact. Their interaction is inherent to silver's dual role. Industrial users, monetary demand, and leverage converge naturally, producing volatility when thresholds are exceeded. Observation of warehouse inventories and registered stocks continues to provide insight. Small shifts in withdrawals or deposits reveal intentions. Patterns that appear insignificant in isolation may indicate structural pressure. Monitoring flows, rather than price alone, offers predictive insight. Historical examples show that informed participants anticipate these signals while the broader market remains unaware. Silver's sensitivity to physical scarcity is enhanced by its relatively small market size compared to other commodities or financial instruments. Large positions can influence price and delivery without widespread participation. This sensitivity ensures that accumulation and preparation, when executed strategically, can materially alter outcomes. Those who ignore these dynamics are exposed to sudden repricing events. Repeated historical silver patterns demonstrate predictable mechanics. Quiet accumulation precedes structural stress. Delivery pressure emerges before recognition of scarcity. Sudden repricing reshapes market assumptions. Recalibration follows, leaving early participants advantaged and late entrants disadvantaged. The market then returns to apparent calm while structural fragility persists, setting the stage for future cycles. Strategic participants recognize these cycles as opportunities to secure metal before stress events unfold. Physical possession mitigates exposure to paper leverage and delivery failure. Markets move disproportionately during periods of scarcity, rewarding foresight and preparation. Those who interpret early signals gain advantage in pricing, liquidity, and flexibility. Timing is paramount, not speculation. Medium-term corrections after a repricing event stabilize markets temporarily but do not eliminate structural tension. Paper claims still exceed metal. Industrial demand continues. Monetary demand reacts to trust and scarcity. The system remains sensitive to concentrated accumulation and delivery pressures. Structural fragility endures, creating potential for future repricing events of equal or greater magnitude. The dual nature of silver, commodity and monetary asset, amplifies cyclical dynamics. Industrial consumption ensures baseline demand. Monetary accumulation introduces episodic stress when confidence in paper claims diminishes. Price discovery alternates between gradual adjustment and sudden repricing. Volatility is inherent, magnified by leverage, and constrained by physical availability. Understanding this duality is essential for long-term strategic positioning. Lessons from repeated historical silver patterns are clear. Cycles are structural, not speculative. Early accumulation determines advantage. Scarcity dictates outcome. Paper claims can be misaligned with reality, producing opportunity for those who recognize divergence. Repricing events are sudden, often violent, and followed by recalibration. Long-term positioning requires awareness of these mechanics and patience during quiet phases. Even after recalibration, the market remains sensitive to small changes in supply and demand. Structural pressures persist. Future cycles are inevitable. The quiet phase will return, offering the same opportunity to those prepared to observe flows, control possession, and act strategically. Silver's market may appear calm, but beneath the surface, the forces shaping future repricing continue to evolve. Preparation ensures advantage, neglect ensures exposure.